So the main reason why so many people get involved trading options is because they have this allure, this dream, and information out there that tells them of how easy and fast and big returns can be had with just these instruments and these products without having to tie up as much money of owning stock. Well, the reality is that trading options is difficult. It's more difficult and one of the most difficult products to trade. And most people should not be trading options. They shouldn't be. This is a different stance that I took many years ago, but as I see more and more now, and I say that not to discourage, but to understand when you are trading options, you are playing a game of chess against some of the best players out there. If you have a directional bias, just buy stock. Just play the stock. Yes, you tie up more capital, but the stock has embedded statistics that help you, especially when you're going long. You have the natural market bias higher in the stock market, which again helps the average investor or trader to be right and be able to hold on even if they are wrong. When it comes to options, it's fast moves and it makes it very, very difficult, especially the ups and downs. So one trick I'm going to share with you right now is understanding why you need to manage your option profits, because profit peaks in options happen just like that. I mean, they come very quickly. I'm going to show you this example here of some activity that I picked up yesterday, and I want to walk through exactly, not specifically as I took this trade, but a case study of things that I've seen over the last 15 years and recently with these meme stocks and the Reddit stocks and so forth to kind of help you understand why maybe sometimes you want to use the stock versus the option if you're playing direction. So we're going to take a look here at Global Star GStat. I'm pretty sure this is a stock yesterday that was talked about on the Reddit forum. It got going here from $1 to $1.20. Now this would be a perfect instance. Yes, there's options available on here. There are options available on GStat, which we'll take a look at here in a second. But if you're trading the stock here, if you're trading momentum, if you are bullish on the stock and you want to do this, it's better just to trade the stock here. It's $1. At the time, it was $1 stock. It is essentially an option, but you get a cleaner entry and exit where you're talking about possibly, I didn't look at the bid and offer or the bid and ask on here, but we're talking about maybe a penny to get in and out, and you don't get as much leverage, but it's a lot easier to trade. So this is these penny stocks offer a great edge for the little guy. The reason why is because the institutions can't play in this marketplace. So you have a lot of volatility. You have the opportunity to play momentum and to get the volatility to have a two-sided market. And that's what you really want. This is one of those. If you look to the left here, nothing's happening, right? It's dead. Well, when do you want to get active with these types of stocks? When there's activity, when the emotion's high, when there's trading, a lot of volume coming in here. That's opportunity. When that market's buzzing, as it was yesterday, then that's the opportunity. That's where you want to be part of it. But you don't want to own it. You just want to trade it. These are where opportunities are, and understanding where edge for the little guy is at, this is one of those. These 4-ticker stocks, these stocks that are under the radar, they're not where the big boys plays. That is not where the edge is for the little guy, for you and I. But there are opportunities here. The thing to understand here is that you typically will see, this kind of move here, especially into the afternoon. You get these big pushes in the afternoon and they back off here. But you notice here then it kind of makes this this wedge here. You got this resistance here and it kind of ticks, and then makes a breakout, market closes, and then you get this gap higher. I recently have seen these gaps higher, even if it hasn't closed at the high of the day for the previous session. So the theory on these stocks is that if you close at the highs into the close, you get the continued momentum the next day. But if you notice here on the 5-minute candle, you do get that gap higher, but then it fades down and gets backed up, or it backs off a little bit. So the rule of thumb here would be you sell into that move. Now, the reason why I'm talking about this specifically and looking at this one is because yesterday I picked up this activity in Global Star. See this big activity here. You got 26,000 calls traded. You look at some of the action here, and this was a highly active stock. To me, I don't understand why someone would buy these options here. They're buying them from 15 to 30 cents, and you had 26,000 contracts traded. We'll look at today's activity to see how many stuck, but they were being bought. I know for sure that they were being bought here. So when you buy these options, especially on a stock like this, you have to have you have to have an expectation. You buy an option, you got to figure out what that option is going to be worth at what price. So these are inconsistent products. You have implied volatility as well. So we've talked about implied volatility. Implied volatility on this overall is 206. That's high volatility. It's extremely high. So this is already baked into the stock here. Got a 65-cent move for the next 25 days, higher or lower. That's already baked into the stock here. So even if it goes to $2, it's already baked in. So you have to understand when you're trading these these products, if you're trading the stock, much easier, but they do move pretty quickly. And also when you're trading the options, to me, these were just Reddit buyers. I do see some blocks of 1,000, so it's not little retail money coming in here, but there was some decent block sizes of 1,000 being bought here, and again from 15 to 30 cents. So they could have been seeing the Reddit and using that momentum to sell into it, but they're not looking to hold it. So one of the things that will help you be successful trading options or even stock is that you have to manage your winners. You have to manage profits, and you have to have a realistic approach to making money. You can't look for 300% gains. You can't even with options, honestly, look for gains of, I would say, consistently of over 50%. Sure, they do happen, but to be consistent, you have to chip away, you have to use that leverage and be realistic with the gains that you have and be able to chip away for it. So for this one, typically I have a rule that gains of 30% are taken off. If it hits a 30% gain from my back testing, what I've seen, if an option hits 30% gain, then I'm out of it. So that doesn't mean that I miss 200, 300, 400% gains, because what we see here is you have gap risk. This is what people forget. There's gap risk in stock, equity gap risk. It could go higher, it could gap higher or lower. So just because I have a profit target of 30% doesn't mean that I buy here and then the next day it opens up much higher. Well, if it does, then I get triggered at that price, and that execution price could be much higher. It could be 100%, 200%, 300% gain. But you can't play for the home runs. It's like playing baseball. You go up there to win, not to hit home runs. Same thing in trading options. Same thing in trading stocks as well. You got to be able to manage it and chip away at it, use your capital. Not look at paper profits, but look at real profits here. So you see here as well, when we take a look at, we'll take a look here at what stuck yesterday. And we look at so you got another 35,000 contracts traded, but 17,000 traded. So some of that was two-sided trading here, but a good amount of those did stick. But we take this and we'll take a look here at the contract, specifically on how that traded. So when I talk about profit windows and options, they happen like that. It's very, very quick. And you can see here on a 5-minute that you had a price movement all the way up to 40 cents, and then it backed off. Within 5 minutes, that option hit the high of the day. 5 minutes. We could probably look at a 1 minute to see exactly when that happened. It happened right at the open. So if you had your order entry previously, someone got filled here. I don't know exactly who, but someone printed at 40 cents and someone got filled. And that was the high print of the day. So you had a profit coming in, you sell it, which would have been a 30%, whatever you got in at 20, 25 cents, even 30 cents, you have it in there, executes the next day, and you walk away. Instead of looking at this and saying, wow, I wish I already sold here. So you have your order ready, and you're able to have it execute, especially on the open. I've seen this really a lot over the last 6 months. It seems like I don't have, in my memory bank, it seems that way, but it depends on which stock it is specifically. But this is the importance of having orders in place to be able to execute and not looking for home runs here, because those that bought here, especially what happens in this one specifically, is that someone buys this for 20 cents and they're like, wow, where's this going to go? This is going to go to the moon. Well, it doesn't go to the moon. But if it goes to 40 cents, that's a good return, and you move on and you get out of it. Or if you play the stock, hey, I mean, that's a good trade depending on where you got in and where you got out. I mean, if you I mean, if you got in at 92 cents here, all the way higher here, I mean, there's a lot of opportunities. But a lot of times, those individuals that look for this kind of that play these um, stocks, they're looking at a 1 minute, sometimes 2 minutes. Very. I don't know too many people that trade this on the 5 minute. If you're day trading this, you're looking at a 1 to 2 minute chart, and on this here, you get a move. You have if you bought here at the close to sell at the open here. That's a 16% gain overall, just overnight on the stock. So on a $1 stock, a 16% gain overnight. I mean, you got to be realistic here. So those are the well, that's one of the edges trading these volatile stocks. There are edge. That's an edge for the little guy. Don't get caught up in the fact that Wall Street looks down on these penny stocks and so forth. They don't want you to understand that that's an edge for you because they can't play in that game. They don't care about playing in that game. They're not looking for those smaller profit opportunities. That's edge for the little guy. Also, trading options, you're not looking for big gains. You're looking for a way to create consistency, and the way to create consistency is look for lower profit opportunities, and that means looking at taking 10, 20, 30% gains and chipping away at that to use the leverage, but trading a inconsistent product to try to create consistency. So that's what I have for you today. Look, not everyone's going to tell you that. Not everyone's going to tell you. Most people, I don't know how many people are going to tell you that, but I will. I'm going to share that with you because I want you to succeed. I want you to make money. And I got into options because I thought I was going to make a lot of money too, very quickly. You can make money, but it's not what most people make you think it is. It's not fast, easy, big, triple, quadruple digit gains all the time. There's a lot of chipping away to get at least a couple of those big gainers to really pad and nitro boost that account. So that's what I have. Make sure you leave a comment below. Let me know what you think. Like the video, share the video, and subscribe. I'll see you in the next one.